Hello, this is Mike Swanson. I run the website WallStreetWindow.com. And today I want to talk to you about the outlook for the stock market going into the end of the year. If you can recall, on September the 14th, before the Federal Reserve meeting, I posted a video talking about the bond market and the price of gold because I was watching these very closely that week and I want to see how they would react uh, after the Fed meeting because I believe that would be the main indicator for what the stock market would do, that the action in the bond market specifically was the biggest risk factor to consider. So let me show you uh, what's been happening. Uh, Last week, I sent out this email. The U.S. Treasury bond market has done what stock market bulls needed. And now this email is free, and you can get my weekly updates on my email list with the charts and so forth for free. Just type in WallStreetWindow.com. But what I pointed out was this is the TLT exchange traded fund. And the first circle is what happened last year in September going into January after the Federal Reserve lowered interest rates then. Then they stopped and then they started again this past September. But last year, TLT, which is the ETF for the 20-year Treasury bonds, dumped and corporate bonds fell in price too. What this meant was that the yields on long-term Treasury bonds actually went up after the Federal Reserve lowered interest rates. As a result, mortgages did not decline. People's the charge people have from for interest from credit card companies did not decline, and the interest rate cuts therefore were not very stimulative for the U.S. economy. In this type of action in the U.S. bond market, where the Fed would lower rates and then these long-term yields go up instead of down, and not been seen since 1980. So something extremely significant in a long-term uh, red flag and risk factor that there are troubles in the U.S. debt market, risk factors indeed. And if this type of sell-off happened again after the Fed cut rates last month, I thought the stock market would have a significant decline, correction, whatever you want to call it. But as I wrote and said on September the 14th, I was hopeful that that would not actually occur. And the reason I was hopeful was because that the bonds had not rallied as much into this past Fed meeting as they did the one September 2024. They were not as overbought technically, and so there's not as big of a risk of people selling in reaction to extremely overbought conditions. Last year, there had been a significant rally from May to September in the TLT and across the bond market, and traders aggressively sold that. This time, there really was not a significant rally. And the indicator on the bottom is the 30-day rate of change. I've circled where it was last year. It got to 10% around Labor Day. That meant the TLT had moved up 10% in 30 days going into that Fed meeting, basically. This time it moved up 5%. And really, you can see that it was very narrow price action, very little overall price volatility. That is reflected on the indicator on the very bottom of the chart, the 200-day Bollinger Bandwidth indicator. That's a 200-day Bollinger Band. That's very long-term volatility, and that indicator was at 9. And if we scroll out for 25 years and look, you can see that indicator being at 9 is an extremely low condition. In another sense, what this means is that not only was the 30-day price action going into last week's Fed meeting last month's fairly subdued, but the 200-day average price volatility was extremely low. You have to go back to 2022, 2011, really the 2018, 2019 level to see levels below 9. In 2018 was a time of almost, really, it was historic low volatility in the market. I think the Dow only moved up or down 1%, 1 or 2 days that entire year in 2018. So overall, bond market volatility is shrinking, and I think that is why we did not see a significant decline in TLT, in a sell-off in the bond market, as some were worried about, and I did consider it the biggest important risk factor in the markets, and it didn't happen. And that's set the stage for stock market bulls, the rally not to falter. And if you look at the LQD corporate ETF, this is also an example of what's going on. This is an exchange traded fund or corporate bonds, and instead of selling off after the Fed meeting, it just dipped a point, and now it's back up. So basically, people know interest rate cuts are coming. They know the government is going to lower rates. They know the Trump administration basically wants the Fed fund rate to go below or to 3% at the very minimum in the next 12 months. And they are getting out of money market funds and locking in CDs and buying corporate bonds. And this is helping put money into the overall bond market. And to show you an example of where the yields are, this is high grade corporate debt, basically junk bond debt. And you can see what's happened. The yields have gone down this year. There was a minor move up last year in September, as I said, when the Fed lowered rates with high yield bonds, but they've been going down slowly. So we are in a condition where money is still flowing into the stock market, the financial markets, and that has not been disturbed. And that sets the stage up for the bulls to continue to be in charge of the market, and basically everything is going up. Of course, gold is going up faster than the stock market, better than Bitcoin. Why is that happening? Because this is a long-term risk factor, corporate bonds, the rise in government debt, and the warning made last year in the price action. And so that's one reason more money is flowing into gold. And of course, there's geopolitical reasons, and central banks around the world have been accumulating gold for the past couple years. So I thought I wanted to give you an update on what is going on there. And again, like this video, so I'll do more. And if you are not a free subscriber to my email list, go to WallStreetWindow.com, and I'll talk with you later.